Okay, good morning, good afternoon, good evening, wherever you may be. Maneko 64 here, home of alternative economics and contrarian views. Uh, Hopefully you can hear me and it's not buffering today. Yeah, someone was saying, come on, Mario, you always earlier. So I decided to log in or go live a little earlier. We're about 5-6 minutes early. Some people already gave me super chats even before I started, which is nice. One of them was just a greeting. There's no question. So before I go on to the main topic of the live stream, which is the crack up boom, I'll answer the questions from the super chats that I got. I'll bring one up here. It says, in light of the bonds moving, is it a good idea to fix your mortgage rate now or stay variable? Bank is offering 1.99% fixed for 4 years. This is from Dino Pumpkin in Australia. What I would say, Dino, is if I had a mortgage, which thankfully I don't, I was able to pay it off when I moved house. In my previous house, I didn't have a big mortgage. I always try to pay off as much as possible. But one thing I would say, because there's a lot of people out there who thinks the central banks are going to be able to intervene and drive yields even lower, even though we're seeing them go up and people worry about inflation. I think what I would do if I were in your position, this is not advice, I would maybe fix half of it if you can and leave the other variable. And why would I do that? Well, you hedge. If you fix half of it, if rates go up, you're protected there. And then the other half, of course, would be variable. If rates go down, you can probably fix lower, because I don't think they're going to go much lower than 1.99%. Even though, I mean, if it goes to zero, yeah, then you can always fix even lower. So that's what I would do. The other question was from Super Seamster Suing Show. Hopefully he's here because I think he went off the chat. I did a screenshot of the question just in case, but he asked me about mining stocks. He asked, should I hold them or flip them? Yes, mining stocks are different than bullion, holding physical gold and silver. Yes, you need to be careful. They get very speculative and they're very cyclical. So it's not a buy and hold forever. There will be a time when you'll get out of it. As for which mining shares or mining stocks you should invest in, I would look at the prospectus of the major mining funds like Sprott Asset Management, the GDX ETF, GDXJ, and look at what they're investing in. But if you're going to do more work, more research, you have to, I think you need to look at where the company is politically. If it's stable, you have to look at the management and the directors involved in the company, if they're good, if they've been around for a while. I guess there's also different kinds of mining companies. There's the mature, the big Newmonts or Barricks. They're different than a small exploring company with a market cap less than $1 billion, for example. These are exploration. They haven't found the gold yet. There's also royalty companies, all different kinds. So hopefully that will help you with that. So we still got 2 minutes. So just see, we've got already 350 people even before we start. That's pretty good. Let's see if I can just see who's here and say hello. There's a lot, all the usual suspects and more. The channel is growing. Neil Moy, If I don't say your name, it's not that I don't like you. It's just that it's hard. There's so many people now. Mem No says, I will always mash and share from Mario and Billy. Yeah, Billy's here. He's asleep. Billy does like running around, going out. He goes out more than 4 or 5 times a day. He likes to go out in the garden. So we got another super chat. Thank you, Raleigh 777. First Majestic. Yeah, that's a good one. I think Heckler Mining is a good one too. Hello from Atlanta, Chris Conman. Hi, Chris. Janet from New York City. Still no Jazara. I don't believe in that. Don't wait for Jazara. Look after yourself, you know. Enrique Borns, do you know if Mercury Asset Management is still on London Bridge? I don't know. You need to check their address. I'm not sure if they're still there. Keller Robert from California. Hi, Keller. So yeah, okay. It's 9 p.m. London. So we're going to start now. So I think the title of the live stream is, because sometimes I forget and I can't see the title here. It's whether the Federal Reserve can avoid a crack up boom. So some of you might not know what a crack up boom is. I'm going to reference Human Action, which is a big book by Ludwig von Mises, one of the fathers of the Austrian School of Economics, a treatise on economics. So first, I'll just let you know a little bit about von Mises. And it says about the book here in the back, I'm going to read from the back a little bit. The monumental masterwork of the grand old man of economics, considered by many to be the counterweight of Marx' Das Kapital. So he's the anti-communist. Human Action is the magnum opus of a genius. Ludwig von Mises is now universally acknowledged as one of the fountainheads of the worldwide movement toward individual liberty. Here is the classic defense of capitalism, whose impact and influence continue to grow. So if you want to find out more about the Austrian School of Economics, you should go on this website. This is how I learned about the Austrian School, through the Mises Institute. It's actually in Auburn, Alabama. So if you want to learn more about von Mises and the Austrian School, this is a great website. So let's, I'm going to go through what von Mises says about the crack-up boom. It's on page 427 of the book Human Action. It says, ought to be on the bookshelf of every thinking man, Wall Street Journal. I'm not sure they think like that these days. But here we go. So I'm going to read from page 427. But if once public opinion is convinced that the increase in the quantity of money will continue and never come to an end, and that consequently the prices of all commodities and services will not cease to rise, everybody becomes eager to buy as much as possible and to restrict his cash holding to a minimum size. For under these circumstances, the regular costs incurred by holding cash are increased by the losses caused by the progressive fall in purchasing power. The advantages of holding cash must be paid for by sacrifices which are deemed unreasonably burdensome. This phenomenon was in the great European inflations of the 20s called the flight into real goods, or crack up boom, or in German it was called the Katastrophenhause. The mathematical economists, well, these are the Keynesians, are at a loss to comprehend the causal relation between the increase in the quantity of money and what they call velocity of circulation. So they're always worried about the velocity, but according to von Mises, it's a psychological thing. It's when investors and the public realize there's no end to the inflation. Of course, we have been, how can I say, brainwashed into thinking that there is no inflation, even though they've been inflating the system, uh, you know, out of control inflation for 50 years since Nixon closed the gold window. I'll continue though. We need to go a little further. It's not going to be too long, and then you can ask questions, and I'll also elaborate on this. The characteristic mark of this phenomenon is that the increase in the quantity of money causes a fall in demand for money. The tendency toward the fall in purchasing power as generated by the increased supply of money. So yeah, we've seen that M1 has gone up over 300% in 12 months. M2 has gone up 25%. Of course, Jay Powell said to Congress that money supply doesn't matter last week. But anyway, I trust von Mises more than Jay Powell. Jay Powell is a lawyer by training, not an economist. So he says, generated by the increased supply of money is intensified by the general propensity to restrict cash holdings, which it brings about. Eventually, a point is reached. So this is it. The point is reached. No one will ever know when this point is reached. Something will trigger it. And I think we're closer than ever to this point. All the conditions are there: political, social, economic, financial. So a point is reached where the prices at which people would be prepared to part with real goods discount to such an extent the expected progress in the fall of purchasing power that nobody has a sufficient amount of cash at hand to pay them. The monetary system breaks down. All transactions in the money concerned cease. A panic make its purchasing power vanish altogether. People return either to barter or to use another kind of money. So this is the thing. Von Mises says here that the mathematical economists, well, those are the Keynesians, they think everything's linear, that they can calculate. They're not concerned about hyperinflation or inflation. They say that the GDP is low, the economy is not doing well, and they also say that the CPI or PC is inflation. They disregard the increase in money supply. But according to von Mises, it's a psychological thing. When the public decides that the inflation is never going to end, watch out. So the course of a progressing inflation is this. At the beginning of the inflow of additional money makes the prices of some commodities and services rise. Other prices rise later. The price rise affects the various commodities and services as has been shown at different dates to a different extent. So I think what we've had for the last 50 years, but I would say, let's say for the last 22, 25 years, I would say since the dot-com bubble, yes, money has been flowing into paper assets. Yes, they've contained retail price inflation, even though we had a commodity bubble back in, not a bubble, but a bull market in commodity from 02 to 08. They've been able, the money, the inflation has flown more into real estate, bonds, stocks. It hasn't really flown that much into the commodities. There is no inflation as we knew from the 70s, where retail prices went up. So, but he says here, the first stage of the inflationary process may last for many years. While it lasts, the prices of many goods and services are not yet adjusted to the altered money relation. There are still people in the country who have not yet become aware of that fact, that they are confronted with a price revolution, which will finally result in a considerable rise of all prices. Although the extent of this rise will not be the same in the various commodities and services, these people still believe that prices one day will drop. Waiting for this, they will restrict their purchases and concomitantly increase their cash holdings. As long as such ideas are still held by public opinion, it is not yet too late for government to abandon its inflationary policy. So, yeah, what he's saying here, there's still people who think, yeah, there's still people who think that prices are going to go back down. I think Powell said this week when he was testifying to Congress that, yeah, we're going to see a blip up in CPI, or what he calls inflation, because of base effects, because it dropped a lot last year. But then he said he expects prices to moderate or go, not go up anymore. But we're seeing people like Michael Berry, the guy from The Big Short. He's talking about inflation, even hyperinflation. I've read, and we're going to go through some other guys who are talking about inflation. And these are not just like small people. These are not just Monaco 64 kind of people. These are huge, respected, multi-billionaire investors. But let me finish this and then we'll go through that. But then finally, the masses wake up. So this is where the Keynesians and the people who think we're going to go the way of Japan, that you don't have to worry about inflation, there's always going to be money printing and nothing will happen. They forget that when the masses wake up, they become suddenly aware of the fact that inflation is a deliberate policy and will go on endlessly. Yeah, it will go. And Von Mises said earlier that while people still think inflation is going to moderate or go down, the government and the central bank can still stop that policy of inflation. But the way they're going, they've been doing it since Greenspan, basically after the dot-com bubble. He cut rates to like 1%. He triggered the housing bubble. So we had the dot-com bubble burst. That was the first crisis where they should have let everything go, but they didn't. And then you had the second crisis in 2008. They should have let an even bigger crisis. They didn't let anything liquidate. They implemented QE. They bailed out all the banks. So that was the second one. And the third one, I think we're still in the third one. It started last year in March, and it's even bigger. Look at every time it gets bigger. But again, they failed to let liquidation or deflation take its course, and they're still at it. And I think, yeah, this is the third time. And I think it's going to be like in baseball. 3 times, 3 strikes and you're out. So this time around, I don't think they will succeed. And I think what will happen, we will have the collapse of the currency. It's difficult to say when the masses will wake up, but I think the big investors are waking up. So let's finish here. A breakdown occurs, the crack-up boom appears. Everybody is anxious to swap his money or currency against real goods, no matter whether he needs them or not, no matter how much money he has to pay for them, within a very short time, within a few weeks. So, for those people who think you can buy your gold once the hyperinflation starts, you're gonna find it very hard. We're already finding it hard to buy physical gold and silver right now. I'm going to come to a great video by Paul from Bell and GP, who looks at the gold prices in Venezuela for that. So within a very short time, so within a few weeks or even days, the things which were used as money are no longer used as media of exchange. They become scrap paper. Nobody wants to give away anything for them. It was this that happened with the continental currency. Thank you, Super Seamstress Suing Show, for the super chat. I answered your question about the mining stocks. I don't know if you're here. Let me know, and then I'll answer it again if you didn't hear it the first time. So yeah, continental currency in America in 1781 with the French mandats territoriaux in 1796. That's the kind of like the assignats at the same time, and with the German mark in 1923. It will happen again whenever the same conditions appear. If a thing has to be used as a medium of exchange, public opinion must not believe that the quantity of this thing will increase beyond all bounds. Inflation is a policy that cannot last. So there you go. That's the crack up boom. So I think now we're going to look at some. Actually, let's look at the Bell and GP's video about gold in Venezuela, because a lot of people are concerned now because the price of gold has gone down. You know, silver actually hasn't really gone down that much. It's still holding up pretty well, but hopefully, you know, this will show you, you know, that let's share the screen. Okay, here we go.
As much food in Venezuela now as it could back in early 2017. Here is a chart showing the price of an ounce of gold in Bolivar from early 2017 until now. On January 3rd, 2017, the price of an ounce of gold was 11,515 Bolivar. Now it is 291,988,633 Bolivar. Notice that the price of gold on the chart was barely visible before the failure of the currency commenced. Rest assured, it had a price, and that price was quite volatile for the full year of 2017, much like the price is pretty volatile in US dollars. It is the scale of the chart that makes it hard to see. Let's focus in on an earlier time frame and see what gold's price looked like. Look at this chart for a moment. Let's imagine we have a Venezuelan who had bought some gold. Let's further imagine that the Venezuelan had a typical Western mindset where units of currency was the ultimate goal. Maybe he or she bought in early November 2016 at 13,000 Bolivar and then launched in despair as the price of gold crashed to 11,300 Bolivar in the span of only a couple months. This would have been a 13% loss. Now, I've heard lots of people in the precious metals community fretting and acting in despair that in the past couple of months, gold has fallen from $1,300 per ounce to $1,180 per ounce. That's a drop of 9% in 2 months, pretty similar to what our unfortunate Venezuelan gold holder experienced in late 2016. But maybe our Venezuelan gold buyer was an expert market timer and managed to buy in late December 2016 at the low of 11,300 Bolivar per ounce. Over the next 11 months, he or she saw the amount of Bolivar an ounce of gold could buy increase by 25%. Maybe that was the gain that our Venezuelan gold holder was hoping for, and he or she sold out into Bolivar to spend their gain on something. Maybe some apples. I'm here to tell you folks that using gold for making a currency profit on the short-term fluctuations is really not what gold is for. To demonstrate, let's say that our Venezuelan gold holder thought that 14,000 Bolivar was too pricey for an ounce of gold, and then sold all of his or her gold for Bolivar, waiting for a pullback that would bring the price back down to under 12,000 Bolivar per ounce. Well, what happened after that sell decision? Well, as we can see, in February of 2018, gold changed nearly instantaneously to 33 million bolivar and never looked back. It kept climbing and climbing and climbing until it reached the point where it is now, just shy of 300 million bolivar. This, my friends, is what a currency collapse looks like. It is sudden, and I can't say it comes without warning. However, I can say for certain that most people will be caught completely unprotected and by surprise. This is the currency reset event. Remember what I said earlier about the cost of living in Venezuela going up by a factor of 5,000? Well, the price of gold increased by a factor of 25,350.
Okay, so I hope I hope that helped people, calm people down. I would say as well though that Paul from Bell and GP, I highly recommend his channel. I've done a interview with him. He's done an interview with me probably about a year ago or so. He made a video, I think it was today or yesterday, talking about how if you're uncomfortable with the price moves in gold, then you should think about diversifying a bit more. He said, everyone has his or her own risk. How can I say risk? Or every person is more susceptible to risk in a different manner. I'm comfortable with sitting with my gold and silver, most of my savings in gold and silver, because I've done so much research, and I think there is no other way out. So, but I think what Paul says, that the best, if you are concerned and if you still think a lot in fiat currency prices or units, like he says, maybe diversify a bit more. Maybe have 40% in gold and 50% in treasury bills or something. But yeah, it all depends on how much risk you can bear to take, how much you can bear to see, the value of your the fiat value of your metals holding go down. I personally think only in ounces and grams, and I try to forget about how much I have in pounds, because I know that eventually what happened in Venezuela is going to happen here and everywhere else. Tom Taylor, thank you for your super chat. Says, I'm honored to have you as a mentor, Mario. Thank you. So have a look at some questions now. Mr. B says, hit the likes. R. Sinclair, he believes that your portfolio should be between 5 and 10%. What does that say? Well, I think, it depends a lot. Yes, I think Jim Ricketts says 10%. I personally, what's his name? Egon von Greyerz says everything in gold and silver. I guess if I look at my assets, I have my house, which is, there's no mortgage on it, and I have my precious metals. I have very little fiat, so that's how I'm comfortable with it. And the thing is, I've been stacking gold and silver since 2002. I've been through these ups and downs, and yes, they're not easy, but I always think when these things happen, do I really want to jump onto the fiat currency bandwagon? Do I really? Because the other thing is, when you go onto fiat currency, you're financing the big banks, you're financing government, and I don't want to finance them. So that's the way I think as well. Yes. And I sleep soundly at night, even when the price of gold goes down $50 in a day like it did yesterday. It doesn't really affect me. Yeah, it's not nice, but I know that eventually what happened in Venezuela there, what Paul was talking about in that video, that will happen here. And as I said, it's going to be too late to get out of the fiat train. Jordan Moe, when the Fed's balance sheet goes towards 8 trillion, what price do you think gold will be at? And do you still hold your big short theory? Uh, yeah, I'm not sure where gold will be. Well, we're only 400 billion away from 8 trillion. I still think, yeah, the big short now is currencies, fiat currencies. I still hold on to it. We're hearing, we heard a guy from the ECB this week, late this last week, saying they have to increase QE because interest rates are going up, yields are going up. We had the Reserve Bank of Australia. They surprised the market. They bought, I think, this Friday, 2 billion worth of long-term government bonds. And we heard Brainard and Powell saying they're going to keep the short-term Fed funds rate at zero, at least until 2024. So, and if you were here when I was talking about the crack up boom, Vamisa says, unless the government and the central bank end the policy of inflation, and this is a policy of inflation. We've had it since 1971. It's gotten out of hand since the beginning of this century. They're not going to stop it. So I still think being short currencies is the big short, and it's the big short to end the whole fiat currency system. It won't be pretty. Just like '08 wasn't pretty. The whole system almost collapsed in '08 as well. But this time they won't be able to save it, because if you don't have a currency that's worth anything, you can't save it. So we have a few super chats here. MKAY McKay, thank you. If silver and gold explode, do you think real estate will keep going up too? I'm not sure whether to buy or wait. You see, I don't consider real estate as an investment unless I'm going to buy a second property. I consider it as a home, but no, I don't think real estate does well in a hyperinflation, because people were buying in Germany after the 23 hyperinflation. I heard there's a young guy who worked in a hotel, and some tourists gave him a $20 gold piece, which is just under an ounce, and he was able to buy a hotel during the hyperinflation. So yeah, I'm not too sure, but if you're buying to live there, why should you worry about it? I mean, it's a home, and that's the way I look at it. Yannick Bopra, thank you for your super chat. I'm just following central banks. Chris Conman, thank you for your super chat. Is there any way to accurately extrapolate the data between how much the Fed prints and the rise in gold from it? Does the US debt have to get 35 to 40 trillion before we see significant rise in gold? For a few years there, between 2011 or 2013 and 2018, really, gold started picking up. 2019, we broke through 1350, that was going up. And then, yeah, it pretty much matches the debts, but also gold follows the Fed's balance sheet. I don't think it's, how can I say, it's something that you can follow like scientifically one for one, but I don't think, I personally think gold will pick up again much earlier than when we get to 35 to 40 trillion. I think we're almost at 28 trillion right now. So yeah, I don't think we're going to have to wait until 35 or 40 trillion if we can get there, if they can create so much debt before everything implodes. So I wanted to show you a few more things here. So we did look at the Venezuelan gold. So this is another guy here. The thing I would say, just because these people are saying this doesn't mean it's going to happen. But the fact that a lot of these guys are saying the same thing, is concerning, I would say. So this is the guy here. Brace for rampant inflation, hedge fund billionaire stunned at market craziness, sees trouble ahead. So this is the guy here, Paul Singer, Elliott Management. So he sees inflation. So I'll just go through this a little bit here, this article. And Zero Hedge, they do note that they've been calling for this for a while, and it is frustrating. And I think it's what von Mises says. It's difficult to know where the inflation is going to flow into and how long it will take. But I think we're getting a lot closer. So this is what he said here. Inflation spreading both scope and intensity. If and when it breaks out in an inescapably broad way, there will be a crowd of seriously confused policymakers making excuses and claiming that inflation does not, in fact, exist. It is not their fault. It was completely unpredictable, or it will be actually be good for people. So what else? So this is what he's saying now. Singer is readying himself for the final victory lap as he tells investors in his latest letter that he can't wait to say, "I told you so," having long warned of an ugly end to the Fed's extreme and getting extremer easy money policies. We believe that hindsight will show the champion of head-smacking craziness in the American stock market to be the period playing right now. The 76-year-old exclaimed, adding, a flamboyant lineup of excesses will come back to haunt investors. The invisible hand behind all this excess is, in Singer's opinion, the Fed and the rest of the world's central banks, banking copycats, as he echoes Michael Big Shortberry's recent warnings of out-of-control rampant inflation that will shock policymakers, stock pickers, and bond investors alike. So he says, trouble ahead is signaled by a rare combination of low quality securities, staggering valuation metrics, and over-leveraged capital structures, a scarcity of honest profits, a desperate dearth of understanding evinced by the most active traders, and economic macro prospects that are not as thrilling as the mob's brain buy. So, and actually this is what he said in 2012. He says, nobody in America has actually seen, or most people probably can't even contemplate what an actual loss of confidence, and he means the currency, may look like. If you think about some of these elements and how they might interact, you might come up with other paths of transmission or risk pain, but I wouldn't go about your business thinking it's business as usual in the typical post-crisis, post-bear market recovery. So there you go. Let's get rid of that article. We're going through it. I've got the next one up here. Mr. B says, hit the like buttons. How do we reply to comments? My iPhone won't let me. Yeah, so let's just talk a little bit about the bond market. I have been warning a little bit. I've been warning about bond yields for the last month, maybe more, because I've seen commodity prices starting to go up. So I wasn't surprised. I've been telling people the first level we had to look at was 1.3% in the 10-year. And it broke through there. And someone said, and it happened maybe 2 weeks ago, and someone said, well, you said all hell was going to break loose if it broke 1.3. And I said, well, it won't happen right away. And last week we saw that all hell was breaking loose because we broke 1.3, we broke 150. And once it broke 150, it jumped in the same day to 161. But we did close the week around 145. But still above 1.3. And I think there's a lot of people out there who are complacent. maybe not Paul Singer, maybe not Warren Buffett, and I'm coming to Buffett in a minute. But yeah, there's a lot of people. I have a friend in the city of London. He was actually the guy who hired me to come work in London in 1992, because I was working for a small fund manager in Geneva, Switzerland. And this guy, he contacted me because he knew my sister, a good friend of my sister, and he was starting out in London, a bond department, and he hired me, and I still talk to him, and he thinks we're going to go. He thinks the 10-year yield is going to go negative, so he thinks bond prices are going to go up. He doesn't believe in inflation. So there are people like him, and there are people now like Paul Singer. There's people like Michael Burry from The Big Short. There's people like Warren Buffett who are warning. So there's two camps, really. So we can't be really sure. My gut feeling is that people like my friend, I spoke to him, I think Friday. He still thinks, oh, don't worry, yields, and he's buying bonds because he's quite well off. And so he has a bond portfolio, but he has gold too. But he thinks we're going to have deflation. I'm not too sure. And this is going to be the big test, whether investors are going to buy into the Fed. If they increase QE, will investors be comfortable? Because, you could see a rush to the exits from the bond markets, even if the Fed comes out and says we're going to, increase QE, or we might see bond yields go down, but we could see the dollar go down. We could see all currencies go down massively. How can they do that? How can all currencies go down? Because one has to go up or down. Well, they'll go down against real things, and that's when you get the crack up boom. So we could have a crack up boom while yields are actually very low, or we could have a crack up boom if yields go up. So it's crazy. I think it's crazy, and I think either way, if the Fed institutes yield curve control and starts printing even faster to keep those yields low, I think it's going to put a rocket up precious metals. I think commodities are pointing to that as well. And if they don't and yields go up very quickly, it's not going to hurt. It will be a sign of inflation. It's not going to be a sign of a economic recovery. And I think gold will do just as well, and silver and other commodities. You just have to look at what happened in the 1970s. You had a bear market in bonds, and you have a bull market in gold, silver, and commodities. Joker Alpha, thank you for your super chat. How did the rise and fall in bond yields cause pandemonium? Well, the thing is that bond yields are the price of money. So the lower the bond yields, or the higher the bond prices, because when bond prices go up, it means investors are comfortable. They don't think there's any inflation risk. So, or they think the central banks are going to come and buy the bonds. So bond prices go up, yields go down, the cost of money goes down. So when the cost of money goes down, like growth companies in the stock market, and growth, I think it was Peter Schiff said that in his video this weekend, and he explained it well. Growth companies, they don't make any profits. So if putting your money in the bank doesn't give you any profit as well, if it's near zero, the stock market will go up because people are willing to hold growth companies that give you no return, because the money is not giving you return. So the reason it causes pandemonium when bond yields rise is because the cost of money goes up. And these growth companies and stocks and a lot of bonds as well, riskier bonds, higher risk bonds, their prices go down quicker than treasuries, and that's why it causes pandemonium. The other thing I would say causes pandemonium is because when everything's great, when interest rates are low, yields are low, the stock market is booming, people are taking risks. They're leveraging those positions. They're trading on margin. But when it turns, the liquidity will disappear because people are greedy. Unfortunately, even in cryptocurrencies, you look at the exchanges, people are buying Bitcoin 10 times leveraged. So when things turn, that's why it causes pandemonium. And the treasury yields are at the base of the credit world because they are the risk-free rate of return. So when that starts going up, it will cause mayhem in all asset classes. Pace Arrow, thank you for your super chat. Is it worth hoarding pre-82 pennies and also nickels, the US penny? Yeah, I mean, if you have a lot of room, why not? Yeah, I mean, why not? I have some pre-82 US pennies, but I'm not going to get into that because I'm in the UK. I can't get as much. But if you live on a farm and you got loads of room in a barn or something, yeah, load up on that. I've been telling people for years that you have to have physical. Only physical gold and silver will slay the bullion banks. So there's my mug. Millie Billy, what are your thoughts on XRP Ledger having a high transaction fee, a high 20,000 transaction fee, same time Fed system crashed? I don't know. Yeah, there's a lot of people who say that XRP is a banker cryptocurrency. Who knows? One story about XRP was the guy from, I think his grandfather was the Treasury Secretary, Mellon. Mellon banking family. He died and he left. He had hundreds of millions in XRP, but he didn't tell his family about his private key and how to access. So that XRP is gone. I mean, I don't know. Someone said that the failure at the Fed will be an excuse to automate things even more, to make it even more digital. They're blaming it on human error, right? So I don't know. Or maybe it was just a problem they had. It's no big deal, but Grow Mechanic, no, I don't want the pennies. Don't worry. I'm not going to get into pennies. So now I'm going to bring another article that I think is quite important. I know most of us, a lot of times, are critical of Warren Buffett, but I think it warrants looking at what he's saying, because he's not a stupid guy. He's done well. I know he's connected to the deep state. I think he bailed out Goldman Sachs, didn't he? Because he knew the government was going to bail them out. But the government had to have his support to put the $5 billion into Goldman Sachs to make it seem like, was the right thing. And he made billions from that, of course. But he says here, bonds are not the place to be these days. Berkshire Hathaway chief tells shareholders in his annual letter. Warren Buffett warns of bleak future for debt investors. So what's that got to do with rising yields and rising interest rates, Fed losing control? Well, because if you buy a bond, let's say today at par, yielding 1.25%, 10-year notes, and has 10 years to go, if interest rates go up to 5%, it's going to obliterate the principal. If it does that in 3 years' time, your $100 is going to be worth like $60 or $70. So that's what he's talking about that there. He expects interest rates to go up or yields to go up. So it says Warren Buffett warned that debt investors faced a bleak future days after a sell-off pummeled government bonds and sent reverberations through global stock markets. The 90-year-old chief executive of Berkshire Hathaway told shareholders in his closely followed annual letter that it was best to eschew the fixed income market, in which the company is itself a large player. Fixed income investors worldwide, whether pension funds, insurance companies, or retirees, face a bleak future. Competitors, for both regulatory and credit rating reasons, must focus on bonds, and bonds are not the place to be these days. So yeah, there's still fund managers and pension funds that are buying bonds because they're forced to, and they're gonna really lose a lot of money for the people that they take care of the money for. He says Treasury. So I'm not gonna go more into this, but he's also saying that riskier loans, or lower rated bonds, are going to be even worse. And he keeps most of his cash in short-term treasury bills. So 113 billion, all held in treasury bills. He's got 3.4 billion worth in long-term government debt. I guess if yields go up of long-term government debt, even though he has 3.4 billion, he's got the short-term treasury bills. Why is that less risky, the short-term treasury bills? Well, because let's say you have a 1 week or a 1 month T-bill. If yields start going up, if rates start going up, you don't have to wait 1, 2, or 3 or 5 years to to change to get a higher yield. Let's say yields, let's say the 3-month T-bill yield is at 0.25% yield, and you've got that for 3 months. And let's say the short-term yields start going up, and in 3 months' time is at 1%. So you're going to get your money back, and you're going to be able to put it at 1%, so you can protect it. So that's what Warren Buffett does. He keeps, as you saw, all his cash in short-term T-bills. Yes, he doesn't like gold, but that's a different story. His father liked gold. His father knew the importance of gold, not just as money, but as an instrument of control, of freedom. Gold allowed the public to rein in governments. With fiat currency, we can't do that. They've got control because they can print and create as much as possible. Congress can be bought by big corporations, and Congress can buy votes as well. But with gold, it's very tough for them to do that. And his father knew that, and he actually pushed for a gold redeemable money. It's a shame that he doesn't think like his father. Thomas Adams, thank you for your super chat. Hello from Lincolnshire. I'm 29 years old. I have 200,000 in the bank, or 20,000, sorry. I was going to say you've done well, 200,000 at 29. Should I pull 10,000 and put into gold and silver? Well, I don't know your circumstances. If that 20,000 you have is something that you don't plan to touch and doesn't make much difference for you, if you've got 20,000 there to maybe just hold on for a long time, yes, then I would personally do that if I were you. I'm not advising you to do that, but if you've got that 20,000 because you plan to buy a property or a house in 3 months' time or 6 months' time, then it could be tricky, but it could be good as well, because gold and silver have sold off quite a bit, and it could go up. But I would probably, I would probably leave it in the fiat if you're using that 20,000 to buy a property in 3 or 6 months. because the price of gold does fluctuate in the short term. But yeah, if it doesn't matter to you, if you're really holding it for the long term, yeah, put half of it in gold and silver, and maybe don't try to buy it all at once, the 10,000. Do a little bit of dollar cost averaging as well. I mean, buy a little bit, maybe every month or every 2 weeks. Anything else here that I need to show you guys? Oh yeah, I couldn't believe well, I actually can believe this, but it just goes to show that, what von Mises talked about, that once, the only way to stop that they can avoid a crack up boom or hyperinflation is to stop the inflationary policy. And I saw this article here in the FT from yesterday, February 27th, UK to launch mortgage guarantee scheme. Treasury will guarantee portion of loans on homes in England worth up to £600,000. So it says ministers are set to announce a new mortgage guarantee scheme to help buyers onto the housing ladder. So by doing that, they're actually not helping buyers onto a housing ladder because they're subsidizing them. I mean, politicians are really, I don't know what to say. I don't want to use the words that I think, but you can probably, you know, you probably know what I mean. It says an intervention that experts have said is likely to push up house prices. So they want to get people on the housing ladder, but it's going to push up house prices. So what's this scheme then? The scheme, which will be announced as part of Wednesday's budget, will allow buyers in England to obtain a mortgage with only 5% of the property's value to put down as a deposit. So there you go. So if you really think the governments around the world are going to stop the inflationary policy, think again. And that's why I'm not, that's why I'm going to try to keep stacking as much gold and silver as possible. And I'm not going to play these games. I hope that the young guy there who asked me the question about the 20,000 is not going to use that scheme. Be careful, Thomas. Never deal with the government. Never deal with the government. I mean, the 5% down, that's what caused the subprime crisis, not only in the US, but all over the world. So it's crazy. When will the Fed step in on interest rates? When is it too high? Hi, Tony. I think I think right now it's too high because we saw when we got up above 1.5, when it went to 161, you saw what the NASDAQ did, right? So I think they're concerned right now. I don't think it can get much higher than where it is now, the 1.5% on the 10-year. John H., a silver advertising company underway. Billboards, Facebook, Google, Instagram, YouTube, 50,000 donated. GoFundMe. Yeah, I gave I think $20. I think it was Canadian dollar for that. I think they're looking to raise 15,000, but they raised quite a lot. That's good. But, yeah, that is good that they're doing that. But I think in the end, even if we didn't have all, this move to try to publicize about silver, silver would still go up. It might just take a longer. I think the fundamentals are still good. So yes, it helps, but it's not because of that it's going to go up. It's because they're going to keep inflating the fiat currencies. Ray Taylor, yes, money in the bank is an unsecured loan, so it's not even yours. And have you noticed, I mean, I haven't done it in many years because I don't keep much in the bank anymore. But I remember back in the 2000s when I was buying, stacking gold, and I wanted to get 5,000 pounds out of the bank. They looked at me as if I was a criminal. And I used to say, it's my money. I'm not going to tell you why I want it. So yeah, they make it very hard, and it's not yours legally. Mr. Ashford, how would the Fed reduce the yield? Well, by buying bonds. That's what they do. That's what QE is about. What they do is they create money out of thin air, which in their balance sheet it's called reserves, but it is money. So let's say they do it every week. They take $120 billion, they go into the secondary bond market, and they buy bonds from the primary dealers. They suck up the bonds from them. And when you buy bonds, the yield goes down. And especially if they were to announce that we're going to increase the QE, which is right now, I think 120 billion a month. If they were to come out and say, we're going to increase it to 200 billion, uh, the market would, all the hedge funds, all the banks, they would front run the Fed. And by the time the Fed starts buying the bonds themselves, they're going to be at a lot higher price. and the people who bought on the announcement are going to be selling. So that's how they do it. Shane O'Donnell, hi, Mary. What's your take on the housing crisis around the world? Well, we don't have a housing crisis right now. I guess for people who own houses. uh, but I think what you mean is for young people, and that, yeah, it's all created by government. I just showed you the article that the UK government is going to have another scheme to help house prices, and they say it's to help people get on the housing ladder. If they really wanted to help young people get on the housing ladder, they would raise interest rates or let interest rates go up to a normal price level, and then house prices would come down. Would I be annoyed that if the value of my house went down by 30%? No, I wouldn't, because I don't have a mortgage, and all it would mean is that houses everywhere would go down 30%. So it wouldn't matter to me. It does matter for people who are leveraged and have borrowed a lot. So that's the way to solve the housing crisis, but they're never going to do that. Unfortunately, it will all collapse eventually in the hyperinflation, and then nobody will be able to buy a house except people who have real money, gold and silver. So there you go. And the people who have mortgages, those mortgages won't be written off. Um, they will make sure when they draw the system, the new currency or whatever, that you're still going to have a mortgage that is very similar in value to what you had before the hyperinflation. So don't think that just because we get a currency collapse that your mortgage is going to be written off. The best thing is to try to pay off your mortgage, really. All right, we got about 3 minutes to go. Yeah, the bond vigilantes, Mr. Ashford, they've been in hibernation, but I think they're starting to wake up. I just spoke about these big investors like Michael Burry, Warren Buffett, Paul Singer. They're being bond vigilantes by what they're saying here, but they could wake up very quickly. Yeah, there's a comment from I think it was the chief of staff under Bill Clinton. He said that if he could come back, um, if he could come back as something, he would be a bond, right? Because they learned quickly, the Clinton administration, that they had to keep the bond vigilantes, happy. Yeah, or else you can't run the government when yields and interest rates start going up. Super Seamster. I have silver. I wish I had gold, but that's okay because I have silver. I agree with you. It doesn't matter. I think silver will do well. Silver will outperform gold, but gold will do well as well. Darko Risteski, when can we see gold silver price going up? I don't know. I don't know. I'm not really a market timer. I have traded in the past. You know, I worked in the city as a broker for over 20 years, but I think that's the other thing that's going to change uh, with a currency collapse is that all the trading, all the financial, you know, all the stockbrokers, everything like that, um, that, you know, that's going to go, that's a bubble itself, you know, all the looking in the trading. So I hold gold more as a insurance protection. So I don't know when it's going to go up, you know, I think it should be a lot higher, but it isn't. Glint share sale. Yeah, I got an email from them. Yeah, they are gonna raise capital. I'm not sure if I'm gonna put some. We'll have to see. I think people who have a Glint account are, getting that. Lord Humongous is wearing his Billy Airways hoodie. Yeah, the Billy Airways. I think it was one of the viewers, it was Pablo Pina, who said, because last year when the crisis started, they started bailing out airlines, and I said, well, Billy, Billy is a free market guy. He doesn't think they should be bailed out. So Pablo Pina said, well, we should, create a Billy Airways. There's always a silver lining. Chris Coleman says, thank you, Mary, for another sound class in economics. Oh, you're welcome. Oh, yeah. So, yeah, it's time. Yeah, Billy's snoring quite a bit. Bob Hunter, I haven't seen him. No. What's your opinion, Martin Armstrong? I'll finish with that question. Martin Armstrong, I've been following him since 2007, 8, I think. He was still in jail at the time, and he was writing from jail. And one of my friends, pointed me to that. It was on Scribit, and he was writing a lot of interesting things um, about the system and cycles, and then he was let out of jail. And ever since, I haven't really followed him too much. He seems to have changed a lot, his tune. But I see that he's getting more and more also, bullish metals and bearish currencies. So yeah, I think he has a deal with the powers that be since he got out of jail. He doesn't. He's not as interesting as he used to be when he used to write from jail. What do you think of Bolsonaro? Nothing. I don't think anything about any politician. Uh, I think it's a waste of time to dwell on politics. You have to look after yourself. Yeah. So I couldn't care less about Bolsonaro or Mickey Mouse for that matter. So there you go. I'm sorry if that wasn't a good answer for you, but I don't really follow politics that much. So thank you everyone for showing up. Thank you for all the questions and all the support. And I'll talk to you tomorrow. Let's end the stream.